Welcome back to the deep dive. You know, when we look at retail earnings, we're usually hunting for a clean story, right?
Right. Either a big comeback or a clear sign of trouble.
Exactly. But every so often you get a report that's, well, it's both. It's this perfect split.
Internal strength clashing with, like, external disaster.
Yeah.
And that is the perfect way to describe Duluth Holdings.
Duluth Trading Company, their Q3 results from December 16th were a masterclass in this.
A total classic retail drama. Management delivered on their promises, but the market delivered a very harsh verdict.
And that's our mission for this deep dive. We need to unpack that tension. How does solid execution lead to a stock collapsing?
It's all about where you focus. Quality of earnings or the fear of a shrinking top line. Let's jump right into the numbers.
Yeah, give us the snapshot, the beat and the plunge.
Okay, so the bottom line was a definitive win, an adjusted EPS loss of negative 23 cents.
And the expectation was what?
The consensus was looking for a loss of 46 cents. So they basically cut the expected loss in half.
That's a huge beat.
It's a massive beat. And adjusted EBITDA, it improved by $5.5 million year over year. I mean, that's real, tangible progress on profitability.
Okay, so the business is bleeding less cash, and it's doing it faster than anyone expected. That sounds like a turnaround story to me. So what went wrong?
The top line. Revenue. That's where the pressure was just immense.
Weird number.
Sales came in at $114.9 million. The street wanted to see over $117 million.
So a miss, but is that enough for a panic?
Well, it wasn't just the miss, it was the decline. That's a 9.6% drop from last year. The market just saw a business that's shrinking and shrinking fast.
And what about the quality of those earnings? Did the margins at least hold up?
They didn't just hold up, they expanded. Gross margin was up 150 basis points.
A full point and a half?
Full point and a half to 53.8%. And, you know, in this kind of retail environment, any margin expansion is a win.
And they did this while dealing with other headwinds, right?
Exactly. Management was very clear they absorbed about a $3 million tariff impact.
No.
So to expand margins despite that, it's incredibly disciplined work.
Okay, so there it is, the perfect drama. A huge earnings beat, driven by margin discipline, but a big revenue miss that spooked everyone.
And spooked is the right word. The stock, DLTH, was trading around $3.13 before the call.
And after?
It closed the day at $2.21.
Wow. That's a drop of almost 30%.
29.39% to be exact. On huge volume, too.
What does the volume tell you?
It was 3.7 times the day before. That's not just, a few small investors getting scared. That's institutional money hitting the sell button hard.
So the big funds decided the sales outlook was more important than the current profitability.
That's the story. They punished the forecast. But to understand why, we really have to look at management strategy. This was all part of a plan.
The promotional reset, right?
Yep. It's a classic move. You stop chasing every last sale with constant discounts to try and restore your brand's pricing power.
So fewer sales, but better quality sales.
That's the idea. And they were aggressive about it. They said they cut global promotional days by more than 50%.
Half the sale days? Gone.
Just like that.
Yeah.
And you could draw a straight line from that decision to the margin expansion.
How so?
It drove up their average unit retail, plus the AUR. It was up 6% this quarter. Basically, the average price people paid for an item went up because fewer things were on sale.
They're training their customers to stop waiting for a discount.
And that's a painful process. But they're also getting smarter on costs to help offset those external pressures you mentioned, like the tariffs.
Right, the sourcing.
They specifically called out direct-to-factory sourcing. So cutting out the middleman. It gives them more control, better costs, and helps protect those margins.
And this discipline isn't just on the income statement. It's showing up on the balance sheet.
Oh, absolutely. The balance sheet cleanup is maybe the most impressive part of this whole thing.
Talk about the inventory.
Inventory was down 17% year over year. That is a $39.2 million reduction. For a retailer, that is just, it's a massive breath of fresh air.
It frees up so much cash.
A ton of cash. And it led to them finishing the quarter with almost $90 million in net liquidity. So internally, the plan is working perfectly.
But that's the core question, isn't it? If the plan is working so well internally, why are they still having to cut the sales guide so drastically? It feels like the trade-off is more painful than they expected.
That's the tension, 100%. The plan is working, but the consumer is weak, and they're shedding those discount shoppers faster than they can replace them with full-price buyers.
Still, they are seeing some operational wins translate to the customer, right?
They are. Their big automated fulfillment center in Adair shipped over 60% of the units for the fourth quarter so far.
That's a big jump from last year.
A 20-point increase. And it means real benefits. On-time delivery is over 90%. And on Black Friday, their in-stock rate in stores was 97%.
So if you wanted to buy something, you could find it, and it would get to you on time. That builds loyalty.
It should. And they're seeing success in their core products, too. This isn't just about cutting.
Like the men's denim.
Exactly. Men's denim sales grew 9% and at higher margins because they put some national advertising dollars behind it. Women's had some bright spots, too, with their heirloom garden collection.
And I saw that holiday collaboration they did with Hasbro.
The Mr. Potato Head and Tonka underwear.
Right. It sounds silly, but they said it was one of their fastest-selling collaborations ever.
It shows they can still create a buzz. And it all connects back to the customer metrics.
So the total number of customers is down.
Yes, that's the trade-off. But for the customers who stayed, sales per customer, margin dollars per customer, average order value, all of it was up.
Higher value engagement.
They're choosing quality over quantity.
Which brings us to the guidance. The moment the market just lost its mind. If operations are so tight, the forecast must have been a horror show.
Well, here's the crazy part. On profitability, it wasn't. They actually pushed their adjusted EBITDA guidance to the high end of the range. They're now expecting 23 to 25 million for the year.
So they're getting more profitable faster.
And they're saving more money. They said the full year cost savings will be closer to 12 million, not the 10 they originally targeted. All profit levers are moving in the right direction.
So they told investors, we're going to make more money and our costs are better than we promised. And the market's response was to sell.
Because of the sales cut.
Yeah.
And it was a brutal one. The old forecast was 570 to 595 million.
And the new one?
555 to 565. It's a big haircut. And it signals that this promotional reset is shrinking the business more than anyone thought.
And that leads into what they're calling phase 2, which is just more shrinking.
Right. It's a massive KU reduction. They want a more stable, smaller base to grow from later.
How big of a reduction are we talking about?
It starts with 5% this coming fall, winter.
Yeah.
But then it gets radical. Over 20% in spring, summer of 26.
20% of their products just gone.
Gone. And then another double-digit cut after that. This isn't trimming the fat. This is, like you said, pruning the whole tree.
And that's the risk. Does that alienate your core customer who liked that variety?
That is exactly the fear the market is pricing in. The logic makes sense. Sell more of your best stuff, reduce markdowns, but the fear is you shrink yourself into irrelevance.
You can see it so clearly when you look at how Duluth has performed versus the rest of retail.
Oh, it's a stark contrast. Over the last 3 months, DLTH is down 46%.
And the retail ETF, XRT.
Basically flat, down 0.1%. This isn't a market problem. This is a Duluth-specific judgment on their strategy. The market is betting they can't restart growth.
Okay, this is the perfect setup. You have a profitable, disciplined company whose stock just got completely destroyed. Which brings us to our favorite segment.
It's time for the Not Financial Advice segment.
And we have to say it.
We do. This is purely for informational and entertainment purposes. We're just exploring what could be outrageously plausible, not giving you any kind of investment advice.
Okay, disclaimer done. Let's talk about the balance sheet pivot. There was one little data point that management dropped almost as an aside about what happened after the quarter ended.
It was huge. They said that because of a profitable peak season, they successfully paid off their entire revolving credit facility.
So zero debt on the revolver.
Zero. And they ended the week of the call with approximately $125 million in net liquidity.
Wait, $125 million? That's a massive jump from the end of the quarter.
A colossal jump. And this is the asymmetry. The stock is crushed by 30% because of fear, but the company has never been more liquid or operationally sound. They are aggressively turning into a cash machine.
So you have a super liquid company trading at what management has to see as a bargain basement price. What's the trade?
The outrageous but plausible trade is that they use this strength for an extreme defensive move.
A buyback.
An aggressive one. The thesis is they immediately authorize a big share repurchase program. They could even take on a little bit of new cheap debt to fund it, given how clean their balance sheet is now.
And at these prices?
At these depressed prices, they could buy back 10, maybe 15% of the entire company's shares.
So you're basically taking the company private, piece by piece, using the market's own panic against it.
Exactly. You bank on your own operational excellence. Yeah. You believe you can stabilize the top line, even if it's smaller. And if you shrink the share count that much, the earnings per share will snap back like a rubber band. It's a classic value play.
All right, so to wrap up this deep dive, we saw a story of phenomenal operational discipline.
Absolutely. A huge margin beat. They cut sale days in half, inventory down 17%, cost savings on track to beat the target.
But the market just couldn't look past the top-line guide cut. The penalty was severe.
And now the strategic pivot is underway. Fewer products, a tighter ship, all designed for long-term health, even if it means a smaller business today.
It's a painful but maybe necessary move, prioritizing profit per customer over just getting anyone in the door.
Which leaves a really important question for you, the listener, to think about as this plays out. If management really does hit those $12 million in cost savings, and they hit the high end of their EBITDA guide, at what point does all that cash generation and balance sheet strength, especially that $125 million in liquidity, at what point does that finally outweigh the market's fear of a shrinking top line?
Where's the inflection point where profit finally trumps growth? That's the whole story. A fascinating problem to have. That is all the time we have for this deep dive. We'll talk to you next time.